Love this podcast? Support it and sponsor today. Simply head to ozcastnetwork.com for details.
The information contained within this podcast does not consider your personal circumstances and is of a general nature only. You should not act on it without first obtaining professional financial advice specific to your circumstances.
Paul Atherton is an ex-Wall Street advisor on a mission to help young people win back their financial power, wealth and security. He does this by helping them understand the hidden world of finance, risk and investments, helps them figure out how it impacts them, and to seize the opportunities to make it work to their advantage. This is Paul Street Journal. I'm here this morning with Paul Atherton. How are you, Paul?
I'm really well, Tim.
That's good to hear. Now, I've been hearing a lot about money managing, and I was just wondering if you could explain to me perhaps how I could become a money manager.
Yeah, I guess I do hear this a lot. And so I have, 7 major thoughts or rules on following to be your own money manager, mostly because it's not easy. And I think when you first go into it, you need some guidance and some structure. And so the first rule is somewhat cheekily, I say, don't do it. Now, honestly, it's very hard managing your money, investing. And I'm not saying do nothing, because that's actually worse. But what I mean is don't do it, is get some help. Because I really do commend the attitude of taking command of your own money and being interested. That's absolutely important. But when you enter with no experience into the world of investing and stocks and bonds and IPOs and commodities and currencies, derivatives, sort of, you get the picture. It's a complex world. But I'm absolutely not saying do nothing, because that's an even worse decision. So doing nothing is a decision. It's a decision to do nothing, and that's the worst. But when you venture into the world of investing and managing money, I would seriously try and get some help. And I'm not talking about your uncle that has a hot tip, or maybe a friend who thinks they're fantastic at at investing. Really, you need a professional. So that's why we say get a financial advisor, or at least spend some time with one, or perhaps a professional money manager, someone that has credentials. And I'm not talking somebody that has a couple of years credentials either, because it honestly takes years and years and years to get some level of competence. And my preference is, seek somebody out that's had decades of positive experience. Someone like myself, I've decades and decades of working in Wall Street. So don't do it. What I really mean is if you possibly can, before you go venture into this world, get some help. The second, this is a rule that I think all hedge fund managers share in common with me, and that is, it's called staying in the game. So what does stay in the game mean? Well, really, you've heard of diversification, and one of the reasons for diversification is that you stay in the game. Because if you put all your eggs in one basket, honestly, I've actually heard people tell you to do this, and that's their rationales for it. But the problem with that, if you get wiped out, and this happens, you do make wrong bets. The best of the best make wrong bets. They make wrong decisions. Or the circumstances change, and they change rapidly. You don't want to be wiped out, because if you're wiped out, there is no return. Well, the return is extremely hard. But if you're diversified across a large group of assets and cleverly diversified, you will always get in a return. You will always be in the game. So staying in the game is fundamental to managing your own money. So that's number 2. Number 3 is, and this is also a bit tongue-in-cheek, but only slightly, and that's the third rule of managing your own money, is your first investment should lose money. Now, I'm not saying actively look for it, but if you lose money on your first investment, you will learn a very valuable lesson, and that lesson is that making money on investing and on stocks and is not easy. And it is easy to lose money. And I think if you make a lot of money off your first several, let's call them investments, it actually can have a bit of a effect on your psyche and make you think that you've got the touch. Now, I can tell you from my own experience, I think from the first 10 investments I made did very well. And I was professional. My job was to manage risk. I was seeing traders that made mistakes. I saw it all the time. I should have been the perfect person not to fall into this trap, but I did. I thought oh my God, that's it. I know what to do. I've cracked the code. And then on one day, I lost a serious amount of money. And it wasn't a terribly bad decision I made, in retrospect, of course, but it was just a confluence of bad circumstances. But the point is I put a lot of money, on one position, ignoring rule number 2, but rule number 3, which is, don't lose money. Oh, man, I just lost it in a couple of hours. And that taught me something very, very fast, and that is when you're in that losing situation, you can learn a lot about yourself and how you panic and how your emotions go. And I couldn't think of anything. I just couldn't think of what to do. I was out to dinner with my wife. I couldn't even, all I could think about are stocks. I wasn't paying attention. I wasn't having any sleep, and this wasn't a way to live. So I quickly changed my attitude and my approach and no longer was arrogant. So, I'm not really saying actually lose money in your first decision, but be very humble and often paranoid. It's a healthy attitudes to bring to the table. Number 4 is seek out asymmetric risk. It's one of my favorites, and I always do this as I'm obsessed for looking for asymmetry. And that simply means there is more upside than there is downside. And technically, asymmetry works both ways, more downside than up. So you look for something, a bet, a position, a stock that absolutely has small downside but has a lot of upside. Now, they're the best money managers look for this. What they do is and often they have their ratios. They look for 5 to 1 as a classic one. There's a 5. So for every dollar they put down, they expect a $5 return. Now that means they can make 5 bets, 5 positions before they even close to having a problem. But they have made 1 correct position out of that 5 and they've made their money. They're back in the game. They make 2, they're making a hell of a lot of money. In other words, so you search for asymmetry. Asymmetry exists everywhere. It's very good to just look for it and take your time. That's part of being, I guess, humble and paranoid. But asymmetry is there. Look for it and it'll really pay for your time and investment. Number 5 is invest in what you know, which sounds obvious. But okay, so you've ignored me and you've decided to go on alone, but you stayed in the game and you haven't put all your money in the same basket and you're looking for asymmetric risks, but what kind of risks, what kind of positions? Well, invest in what you know. So for myself, I know a lot. I know how to read stocks. I know how to read balance sheets. I know how to look at stocks and bonds and look at risk. But what I'm really good at is global finance, global balance sheets, derivatives, emerging markets. These are my areas of expertise, what I could spend hours doing. I'm very good at that. So that's where I tend to stick to. Now, I had a friend of mine who was very good he was just extremely savvy. He is still extremely savvy in terms of projecting technology in the future. He had a very savvy grip of management, and he's a very senior money manager now. And this was back in the 90s, he told me, he said, I've got this great stock for you to invest in. You've got to. It's fantastic. He gave me all the information, and I read it. I just couldn't get it. I didn't understand. I was just like, it's not my game. So I ignored it, but that stock was Amazon.
Yeah, you missed that one, didn't you?
Right out of the gate.
Yeah.
Like, right. I mean, very, very, it must have been alive for a month or something. And he's done very well off it because he never changed. But now here's the important thing. I invested in China, right? What did I say? I'm very good at emerging markets. I'm very good at derivatives. I'm very good at commodities. Very good at global balance sheets. So I invested in what I know. So I've done pretty well too. So I'm not ashamed and I'm not unhappy with my decision. If you know something, that's what you should be doing. Don't go into areas that you don't know. And make sure you really know it, not sort of surface know it. Number 6 is stay unemotional. And I think I've touched on this, and this is important. I think it's also linked to my point above, number 5, which is investing in what you know, because when you really know something, you tend to be a lot less emotional about it because you're very confident. When you're not confident, you get emotional. You constantly check your position. You look for, oh my gosh, you need validation for what your choice is. You don't need validation if you really know it. You're very confident. Check in once a year. But if you don't, you're you're really part of the game. So staying unemotional is what separates the best from the also-rans. And, you should really not be kept up at night by your positions and constantly checking them. If you do that, then probably you've taken something on that you shouldn't have. And when you're unemotional about it, you take a far more analytical approach to it. You take a far more detailed analytical approach, and that will pay dividends in the future. So stay unemotional. And seventh and the last one is don't churn. I think that's also part of being unemotional. See, churning means you go in, you go out, you go in, you buy, you sell, you buy, sell, buy, sell. And that, again, is what happens when you're an emotional investor. And you go in and you look at the markets and go, oh, my God. And that's the easiest way to get caught up in what I call, selling at the low and buying at the high, which is, of course, the opposite of what you want to do. And churning is all about that. And churning is a sign that you're being too emotional. You don't have a grip of what you're doing. Don't underestimate the transactional costs that come with that. Somebody's going to buy and sell that. There are bid-ask spreads. There are transactional costs. There are money management costs with buying in and out of stocks or investments. So don't churn. Stay solid for as long as you can, for as long as you feel comfortable. So they're my 7 rules, Tim. 7 rules to follow.
Well, that's great. I feel much the wiser. Thank you for that, Paul.
Great, Tim. Thank you.
Paul Street Journal.
Love this podcast? Support it and sponsor today. Simply head to AuscastNetwork.com for details.